All right. Good afternoon, everyone. This is Rich Swerbinski with the Mortgage Collaborative, day 5 of the 12 days of TMC, and very, very happy to be hosting, moderating our industry keynote session to wrap up day 5 here, and want to thank everybody in attendance for joining us here this afternoon. Here with a couple great industry friends, Tracy King Donadio from Partners Credit. Tracy, how you doing?
Good. How are you, Rich?
Doing very well. Sponsor of this session. Thank you very much. You guys have been a great partner to TMC, and I'm going to let Tracy say a few words about her company and to introduce Rob here in a moment. And of course, Rob Chrisman needs no introduction. Always one of our most popular guests, as evidenced by the quickly rising attendee numbers that keep piling in here. Rob, thanks for joining us.
You're very welcome. All the way from Maui.
From Maui, right? Exactly. Yeah, it looks nice in the background there. It definitely does not look like that in Cleveland, Ohio, right now. So,
Nor Chicago, yeah.
Or Chicago. So, Tracy, I'm going to turn it over to you to say a few words about your awesome company and to introduce our keynote here.
Sure. Awesome. Thanks, Rich. For those who don't know Partners, we often get kind of stuck in the simplistic label of CRA. But in reality, we do more than just furnish borrower credit data. We've built our product portfolio out pretty aggressively the last few years, so we can offer a full package of individual and asset and property tools. And while our product suites are backed up by a lot of shiny plug and play proprietary tech, I firmly believe that our industry is and should be a business driven by meaningful personal relationships and industry experience. And these are the sort of values that both TMC and Rob represent perfectly, and why we're so happy to be a sponsor this year. So I'm very proud to introduce Rob Chrisman for you all today. Even though he doesn't need an introduction, I'd still like to give him one. He's best known for his free morning commentary on the mortgage business and the economy. But did you know that he began his career in capital markets 35 years ago in 1985? Or that his background includes hedging pipelines, running a small subprime company, or helping companies' secondary marketing issues on a consulting basis? Or that he and his kids traveled to all 50 states while they were growing up? So my first question, Rob, how many US territories have you visited, and is that next on your list?
Well, Tracy, thank you for sponsoring the session. And U.S. territories, oh my gosh. I've been in a few in the Caribbean. I've been to Guam.
Oh, that was one I was going to wonder about, yeah.
Boy, other than that, I don't know. Does the U.S. have many territories left?
I guess there's 12, but there's 5 permanent.
Really?
Yeah. So that can be something you can look into and a new goal for you.
I will do that. It's easier to like fly to Dallas and rent a car for a week than it is to get to Guam. Guam's a long way away, but I will.
But it's a better story.
Yes, exactly. So Tracy, you mentioned something. I'm not turning the tables here.
Oh, geez.
Too much, but you mentioned something involved with property that Partners does. Can you elaborate just 15 seconds on that?
Yeah, so we're looking at different kinds of tools to look at in terms of AVMs, looking at how we can minimize the reach of how extensive and how expensive these can be. And so we're looking at different kinds of property data that we can incorporate into a credit report.
All right, thanks.
Yeah, thank you.
So sorry for running away there. My dog was pawing at the back door. Probably an appropriate start for this session, which we titled 2020, What the Hell Just Happened? And Rob, you've been in the industry for 10, 11 decades now. What would the single, I got a bunch of questions for you. And I want everybody, any questions anybody has for Rob, comments, anything, just dump it in the chat, the Q&A. Don't feel like you need to wait till the end. The single most surprising thing to you in the year of the weird here?
The single most surprising thing, simultaneously surprising and not so surprising. Not surprising if you know the companies and the people involved, but I would say the single most surprising thing that I've seen is the ability for residential lenders, big and small, public, private, multi-state, single state, to be able to react within a week or two what was happening in March, and be able to, I mean, this word is fast becoming overused, but pivot, to be able to, I'll use transition, whatever you want, change, to be able to shift 90, 95%, for some companies, 100% of their workforce to be able to work from home, almost without missing a step. And it's surprising to have seen the ability of the IT departments industry-wide to be able to accomplish that, and have a minimum, absolute minimum of customer disruption and customer dissatisfaction, because it was like, as an industry, we pulled together and we're able to do this, separately, apart but together, whatever cute term you want to use. But vendors, companies like Partners, Wells Fargo, Quicken, all the way down to Rich and Rob's Mortgage, to be able to do that was surprising to me, and the speed that it happened is just amazing. I mean, it's quite a difference between now and 2008. So the surprising thing, fortunately, is a good thing for this industry, that we were able to do these things and bring in technology and bring in people power, manpower, women power, whatever power you want to call it, empower, to be able to do this is amazing. And like I say, with a minimum of customer disruption, I mean, it's been really neat to see.
It really is amazing. I mean, I remember, when this all started, like I had just co-hosted a session at our conference in February with a couple of lenders of ours about working remote. Like, the theme of the session was, are you, why not? I had some lenders that had already been doing it on a big scale, leading the session. We had about 70 people in the room. 80 to 90% of the people in the room were, we have some underwriters working remote, or maybe most of your underwriters, but that was it. People were thinking about it. They felt like it would work, but just had not pulled the trigger. And then in mid-March, overnight, literally Friday the 13th, March 3rd. I remember when they canceled March Madness, I'm like, all right, this is serious. And next thing you know, everything was remote. And it was almost without a beat. Record year for the industry with almost zero disruption to the end customer.
Yeah, it was amazing. And I mean, look at Tracy. Are those recent artworks on the wall and on the desk behind you?
Yes, this is things that my children have been up to this year to help decorate my office. Yes.
Yeah. So yeah, it is truly interesting, and of course has opened up all kinds of conversations about not only the work from home environment and whether companies will continue and how long they'll continue, or whether they'll offer options to employees. But it's a world of difference between now and say 2008, 2010.
Yep. For those that just are getting on or just recently joined, I'm with Rob Chrisman and Tracy King Donadio of Partners Credit, nice enough to sponsor Rob's appearance here for us at the 12 Days of TMC. Rob, is this, in terms of just crazy factor of a year, you got the 07, 08 madness years, has this been the overall craziest year you've seen in the mortgage industry? And if so, or if not, what have been the other few most memorable years to you throughout your career?
I would say it's important to differentiate between here we are downtown and crazy town kind of thing. What's happening now is different because it is a worldwide, a nationwide issue. It's not only the financial service sector, like in 2008, 2009, 2010. In 2008, 9, 10, 11, 12, 13, up to Dodd-Frank and so forth, the formation of the CFPB. Things back then, they just, it was kind of like watching Breaking Bad, for those listeners, viewers who watch Breaking Bad. It just kept getting worse and worse and worse, and we're like what more could go wrong with Bryan Cranston and Jesse. What more could go wrong? And that's what we were seeing in 2008, 2009. Who's next? Bear Stearns, boom boom. WAMU, boom boom. Countrywide, boom boom. Boom 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 boom. And over time, and then the Federal Reserve stepped in and different measures were taken and Congress got involved. This time around, it was like, it was like just a boom, a shot. And so that's a big difference between now and back then. If you want to go back to, 1986, 87, 88, there was a lot of market volatility, but it wasn't crazy. This time around, it's been crazy, but it's been a shared craziness, worldwide craziness, and the whole healthcare situation has been, it's become politicized, and there are people out there who don't believe in that COVID exists, and other people at the other end of the spectrum who say, who haven't gone out of their house in 9 months. I mean, you have this huge range of issues that are going on this time. So I don't view this time around as quote crazy for residential lenders. I view 2006, 2007, or 2008 as more crazy because it was just, what was next? What was going to come next? This was like, boom. Okay, now let's adapt. Back then it was, what's going to happen this week? What's going to happen next month? How are we going to deal with this? And this time around, obviously, we've been helped by the Federal Reserve coming in and supporting the mortgage-backed security industry, which had its own unintended consequences with margin calls and liquidity, causing liquidity issues for a lot of lenders that were out there. And so this time around, we've had our own set of problems, but I would say I'd say this time around has been better. And maybe that's helped by volumes and margins and the fact that as an industry, we're not the bad guys this time around like we were, 10, 12 years ago. So I would say the crazier time is, 2008, 2010. Tracy, were you in the industry back then?
I was. I have been since 2003. But, I think, to what you're saying too, in terms of what the borrower is experiencing, I think we have an interesting mix of, we've had to advance so much with our technology the last few years, but in our industry, it's so key to have that personal touch as well. I think that we were able to adapt more. We systematically, we've been able to advance our technology so we're less dependent and more efficient, but also can kind of walk the borrower through that experience and also rely on each other to get through it. I think it created a stronger sense of being able to push forward because we are such a different type of industry where you need both of those so much. And I think it shows even more so than ever this year of how equally important they are.
Yeah.
07, 08, the implodometer. Remember, we all remember that, all the companies that were imploding. And then this year, one of the collab labs I facilitated, one of the guys was a joke. He's, oh, sorry, I'm late. The bill counting machine was jammed. So different issues, certainly for the 2 years. So
yes,
too funny. Rob, one of the things I love about talking to you is just you have such great perspective, seeing the industry as a whole, interacting with so many different people in it. Interested in your thoughts and perspective on it. We mentioned work from home, likely here to stay on some level, depending on who you talk to, how much. Other things, trends, maybe both on the consumer level and the lender level. that have spawned this year that you think either may or may not continue, that we've seen this year?
That's a good question. Tracy mentioned technology and the role of technology, and everybody talks about digital mortgages and RON and e-closings and e-this and e-that. And I think that the industry has crammed a year or two worth of technology changes into 6 or 9 months. And I think I think the rate of change will slow a little bit. I think that many companies have brought in technology, new LOS, whatever it is, under some very tough circumstances. Nobody meeting in person, that kind of thing. And I think that it's going to take a little bit of time for companies to really kind of settle in with the new technology that they've brought on, and at the same time keep up on what's going on out there, what's new with regard to what some of the vendors are offering. But we are reminded once again, which I see continuing into 2021 and far beyond, that really this is a people business. I would venture a guess that 100% of the people watching us on the screen here would much rather be sitting there in a conference room or a luncheon or a cocktail party and be seeing other people in the industry. And borrowers would like to be met by loan officers in person. And that's not happening as much, obviously, as I think that people would like to see happen. And so we are reminded of the fact that this is a people business. It's nice to see somebody see somebody across the hall or across the room and go talk to them and just ask them what's going on. How you doing? To have those, the industry misses those kind of casual interactions and those casual conversations. And yeah, it can be in a formal setting, a TMC event, but to go and just like quote, hang out with people that and meet new people spontaneously, that spontaneity has been lost. And I think that we are very focused. We hope to get that back sooner than later for various reasons. So I think that the technology is one thing, but we are reminded of how important it is to sit in a room full of people and listen to a speaker, or to see people to mingle at a cocktail party with people that you've known for years. I think that that's really lacking right now.
Totally. I'm with Rob Chrisman and Tracy King Donadio, Partners Credit. Any questions, comments, please feel free to type them in the chat or the Q&A. Rob, one just came in the Q&A here. Ginnie Mae just came out with some new requirements for new applicants. One of the new requirements is you must have a portfolio that averages at least 250 million over the previous 12 months. Why do you think they added this requirement?
I think that there's a big continued fear by politicians or by regulators about undercapitalized lenders. Can they withstand? We had a big scare in March and April. COVID, everybody was talking about COVID. We didn't know if we could touch a doorknob. We didn't know if it was in our house. There was a lot of uncertainty there, and there was a lot of uncertainty with lenders, and with the margin calls and so forth. Some companies came close to going away entirely with the CARES Act and the value or the forbearance program, and with the feared impact on Ginnie Mae and Ginnie Mae servicing, and the value of Ginnie servicing plummeting, just literally plummeting, put the fear of God into, once again, the industry, but also politicians and regulators and other government officials who thought, all right, can these companies really withstand a shock? Because I'm I've worked for independent mortgage banks all my life. I've also worked for banks. There's a fear, independent mortgage banks have really taken market share away from banks, and whether they do that just through hustle and grit and perseverance, or whether banks like Wells Fargo or Chase willingly give some of that market share away because they focus on other products, that's subject to debate and subject to case by case interpretation. But the industry wants, and regulators want, and the public wants the companies that are doing business with Fannie Mae and Freddie Mac, which are government-sponsored enterprises, or with Ginnie Mae or Ginnie Mae issuers, to have a certain amount of financial wherewithal and stability. And I think that notice reminded us that that's what they want. Now, Ginnie Mae, I think if you look in the fall small print or whatever, you'll see that they have the ability to look at things on a case-by-case basis, or there might be things you can do, or financial stability you can show in one area, maybe not the other, and they may take that into account. So I think there might be, I'm not officially saying there might be some leeway there, but I think that it was their attempt to remind us that they want powerful counterparties and companies that are going to stick around, and stable companies.
Thanks, Rob. And good segue into our next question that came in. Rob, having been through 17 different presidential administrations, what's the biggest real world impact you think mortgage lenders will feel on the change in administrations?
Politics aside, politics aside, I'm just going to say, Joe Biden is going to be our next president. And like I said, I'm sure there are listeners who maybe just switched off or say, no, Donald Trump should fight this to the end, and he's going to be our next president. But let's just say that Joe Biden is going to be our next president. So there was concern going into this that if he is our next president, which he will be, what will happen, A, to interest rates, and B, what will happen to the regulatory environment, AKA, CFPB? What will they do? Department of Justice, are they going to start sharpening their knives again? So interest rate wise, we haven't seen much. I mean, rates have been volatile. They've been, the 10 years still below 1%. The margins are still good. So lenders in theory could improve their mortgage back, or I should say, lenders can improve their mortgage pricing, even if mortgage-backed security prices were to stay the same and the treasury market were to stay the same. They can start to eat into that margin a little bit and actually improve rate sheet pricing. So we haven't seen the dire potential consequences that may have been predicted by some leading up to a Biden victory. So it looks like the market likes Janet Yellen. We've seen Janet Yellen before. I was actually at Cal when Janet Yellen was there. Shows you talk about 17 presidential administrations, but I was there back then. She's very highly thought of, very well respected by many. I think it was a very good choice. And I think the economic team that Joe Biden has put in place has put to rest a lot of the wild predictions that may have been out there leading up to the election, and really calmed Wall Street. We haven't seen stocks plummet like some thought would happen in the event of a Biden victory. So it's kind of steady as she goes with regard to the economic picture. But I will say that somebody at some point is going to have to pay for some of the things that happened during the Trump administration and that will happen during the Biden administration. So someone will have to pay at some point. Of course, we've been saying that for a long, long time, but the debt is getting up there. But that leaves the regulatory environment and the CFPB. And, oh gosh, what is Elizabeth Warren going to do? What is Maxine Waters going to do? Is Richard Cordray going to come back and run the CFPB? Are we going to get rid of Kathleen Kreninger? Or, what's going to happen with that? And the general consensus is that, yeah, the CFPB will beef things up here a little bit. And I don't mean to discount that, but people on the call need to remember that this is a different industry than we had 10 or 12 years ago. I think, Tracy, when you can jump in here, but I would think that the clients that you have are much better run. They're much more compliant. They have a great eye on customer service. And so, and we have the ability to repay that lenders are adhering to, and the stated income and stated asset and the NINA loans or ninja loans, whatever you want to call them. We aren't seeing those. And so on top of that, you have the servicers who have really beefed up their ability to service customers. Customer complaints are way down from where they were when the CFPB started to gain momentum. And so it's not as if there aren't things going on in the industry that need to be corrected. And I'm sure we'll hear about enforcement actions and so forth. But I will say the typical lender is in a much better, more compliant, more customer-centric position than it was 10 or 12 years ago. Tracy, what do you think? What are you seeing?
I agree with that 100%. I think that with compliance and just in terms of how we deal with consumers. So, we have a ton because we're pulling credit. We're interacting with the borrowers, what we've had to put in place in terms of how we interact with consumers, the follow-up we have to do between all the bureaus and their regulations, and honestly, how we can make our customers feel more secure in how we're handling that business, because we're all having to deal with a consumer that we want to work with down the line. So not only being compliant, even though it's a scary word, that compliance is making that consumer feel more secure. And ultimately, at the end of the day, we want as many leads as possible, but we also want to do as much as we can for retention. So they're equally important.
I agree.
Rob, you mentioned a couple different cycles we've seen the industry go through, the too big to fail, big bank era, and ultimately, the fact that ultimately the regulatory community would like to see more of the mortgage business transacted by large public regulated organizations. We've seen independent mortgage banks grow market share since that too big to fail era. And, especially these last 10 years, slowly kind of picking up market share, led by the Quickens, the Loan Depots, a lot of these companies that are going public now. Just interested in what you think the market share pie will look like 5 years from now in the mortgage industry.
It's at some point, the volumes may start to diminish. Hasn't happened yet. We keep being saved by refis, whether they're rate and term refis or cash out refis. The banks, as I mentioned earlier, the Chase, the Wells, the US banks, the cities, and so forth, they are very precise with some of the things that they do. Their profit margins, their pricing down to hundredth of a basis point. They know exactly where they want to be on a rate sheet at any given day, and they know the market share that they want to go after. And there are reasons why big banks have backed away. You look at Chase and the FHA program, for example. I mean, that's the easiest thing. You look at Wells backing away from the broker channel several years ago as another example. So banks are very tuned into what they are doing, and they are in a very good position in terms of their cost of funds. Their cost of funds is very low, unlike a mortgage bank. And so if rates start to slide up a little bit, and I'm not saying they are, in fact, I think we could be here a year from now with the same rate scenario. But if rates do start to slide up, banks, because their cost of funds is lower than a warehouse bank, banks are probably in a better financial position to go after market share. Now, they have not gone after market share for various reasons. So if you look ahead some years, I would say that at some point banks may say, hey, we want to go after this market share. We want to do this. But that's not going to happen for quite some time. So, we'll see. I view independent mortgage banks and mortgage brokers and all the way up to the Freedoms and Quickens and Loan Depots and so forth as very nimble and very well adapted to the current environment. And you have to remember that the Stan Middlemans or the Anthony or Matt Ishbia, I mean, this is their whole thing. They are mortgage guys and gals. And when you look at a bank, mortgage is just a slice of their pie. And so, we have a very quick and nimble and savvy business right now, or I should say thousands of businesses out there originating mortgages, and that's all they do. And they want to succeed. Whereas banks can go back and forth to auto loans or trust services or whatever they might be. So I would say for a while, the independent mortgage bank is going to succeed and continue with strong market share.
Noted there that you punted on the Loan Depot CEO's last name. What is it? Is she?
Shay.
Shay. Okay. All right. So I have a couple more questions for Rob. If anybody else has any questions for Rob, this would be the time to put them in the chat or the Q&A.
Or Tracy.
Tracy, Kingdon Audio Partners Credit. And before I go there, we just randomly picked our $100 gift card winner, Dan Majewski of Hall Financial Group. Congratulations. You just won a hundo. And
wow.
Our team will reach out to you and hook you up with that. So, Rob, what's the one thing you'll be writing about next year that nobody's thinking right now you'll be writing about?
Hiccups?
Come on, I pre-provided you these questions.
Yeah, well, I didn't read them. And I know we're running short on time. I think that I continue to write about saving money for a rainy day. I think companies need to continue to save money for a rainy day, and the rainy day might not happen next month and might not happen 6 months from now. But I think that lenders should continue to use this environment and the margins and the volumes to increase their coffers and prepare for a rainy day. And I know a lot of companies are going public and investors and owners are taking chips off the table, but small guys need to remember that there could be another margin call environment. There could be another, Mr. Cooper just got fined, come up with millions of dollars. So I think that companies really need to keep an eye on that. And what I'm going to be writing about hopefully isn't the fees, but hopefully it's the increased financial net worth of a lot of these lenders that are not going to get into financial trouble because of their reserves. So that's what I hope to be writing about.
I mean, when you think we could be entering whenever, volumes subside here, and who knows when that'll happen, could see the most competitive. I remember 2 winters ago, it was so competitive. There was so little volume. People were just beating each other over the head for loans at sometimes negative profit. Think about what we could be facing now. Lenders have made just truckloads of money this year that they're going to leverage, when volumes start to subside. They've hired so many people. These large lenders are going public and need to show volume and market share increases. You could see just the most competitive, insanely competitive marketplace ever when things turn.
Yeah,
so
we could. Yeah, we could. And I remember, companies looking at rolling out reverse divisions and looking at bond programs and jumbo programs and trying to remember what an ARM index was and so forth. Because they feared the worst, but we've got saved by the rate environment. So yeah, it's always interesting in this business, I'll tell you.
Yeah, just when you think what the hell is going to happen, and right now everybody thinks, it's going to be volume's going to stay great first half, and then it'll slowly trickle off, and we're going to be down 18-20%, but still do $2.5 trillion. I guarantee you that's not going to happen. I don't know what's going to happen, but I sure shit know that I didn't predict the $3.5 trillion or whatever the heck happened this year. It's just insanity. The funniest, oddest, most inspiring email. You get so many email replies. You publish a lot of them. One or two that really stood out to you this year.
There's always some that make me chuckle, either in a positive way or a negative way. And the good jokes that I receive, I'll throw those in my commentary. I would say though that I don't have one that just is going to bring you to your knees in laughter, but I will say that I am constantly encouraged by the optimism of people and the intelligence of people who write to me, and whether it's about something I wrote, or respectfully disagreeing with something I put in my commentary, or whether it's some thought I hadn't thought of. There's a lot of smart people and funny people in this business, and that's why it's fun to be in it. And I'm sure Tracy sees the same thing with her clients. It's fun to be in this because of the people. And so when you talk about email responses, I publish the funny jokes and some of the political comments, oh my gosh, that I received in the last few months have just been, way to the left or way to the right, something else. But I would say for the most part, that people are intelligent and can think on their feet, and that's what I like about it.
Excellent. Tracy, any final questions, comments for Rob here this afternoon?
No, I'm very gracious to be here and that you included me, Rob. You've been fun to get to know you the last couple of weeks to do this, and I appreciate the platform to do so. And I've been reading your emails for quite some time, so this has been very exciting for me. Such a celebrity. But no, this has been great, and I love the content that Mortgage Collaborative has been putting together and the opportunity for all of us to engage with one another between partners and lenders. It's fantastic. So thank you so much.
Yes, thank you.
Downtown Chicago out your window there, right, Tracy?
Yep, that's Chicago. Gloomy, looks like Gotham City today, but
God, like the no travel thing has been great until, like a month ago. I'm ready to get the hell out of Cleveland. Let's just put it that. It's just, man,
I'm ready to go back to New Orleans. It's one of the last places I was. Yeah.
God willing, our conference is at just this absolutely ridiculous resort in LA next summer. So if there's any reason to cheer for a vaccine besides all the obvious ones,
that's it.
That's it. So before we depart, I want to thank everyone for attending. All the sessions today were really well attended, especially this one on day 5 of the 12 days of TMC. Back again tomorrow for day 6. Kicks off at noon Eastern with our good friends Black Knight. They're doing a lightning showcase, really spotlighting really their end-to-end origination experience. So many new things. They've acquired like 7 awesome companies in the last couple of years, and are really doing a good job stringing it together. That's how things start off tomorrow at noon Eastern. And then a litany of keynotes and content-related sessions throughout the course of the day. Tracy, thank you again, and thanks to Partners Credit for sponsoring this session. Appreciate it.
Thank you. Appreciate it.
Thank you. And I want to thank Amy.
Yes.
Amy for doing a great job herding cats. So I don't think. Well, there she is.
Yes. Yeah. She has done a great job.
My pleasure.
Who hosts a 12-day long virtual event? I mean,
right.
It's a little crazy. So,
Hey,
and he is reminding me, I'm interviewing Andre Dawson. I'm a huge baseball fan, as most know. Andre Dawson, I'm interviewing tomorrow at 1:30, the Hall of Famer, the Hawk. So I'm really looking forward to that.
No Rob Chrisman, but.
Well, yeah, I mean, but it's not that far of a drop off. So, but,
right.
And Rob,
Maui.
And Rob, thank you as always. Always appreciate your insight, humor, and all you've done for our network over the years. Greatly appreciate it.
You bet.
All right. Have a great afternoon, everybody. We'll see you tomorrow on day 6. Take care, everyone.